bringing the anchor of CNBC's Worldwide Exchange, Frank Holland. Frank, good morning. So, as we said, the markets yesterday, Dow up almost 8%, the S&P up 9.5%, its biggest gain since the financial crisis of 2008, but not yet back to the levels where it was just last week. So, walk us through the markets, the futures this morning, and also if you can talk a little bit about the bond market. We've been sort of talking in shorthand about that and why it persuaded the president to make this 90-day pause. Why is the bond market so critical?
Well, good morning, Willie. Why don't we start with the equity market and what a difference a day just makes. Taking a look at futures right now, they're pretty close to their lows of the morning. I'm seeing the S&P down almost 2%, the NASDAQ down more than 2% again in the futures market. After that historic rally on Wall Street, after the president announced a tariff pause for most countries, the very notable exception, of course, that's China that saw its tariffs increase to 125%, and China responding with its own retaliatory tariffs. So as you mentioned, the historic rally, NASDAQ's best day since 2001, the S&P since 2008, but we got to keep it all in context. The S&P is still 10% off its 52-week high. The NASDAQ 15% off its 52-week high. We also call that correction territory. So this morning, the markets, they're trying to do the math on what the pause really means when it comes to tariffs. We've seen some estimates, sometimes guesstimates, kind of back of the napkin math on what the new tariff rate is. I've seen numbers from 15 to 20%, still historically high. But the recession concerns, they've certainly eased. Goldman Sachs, their economists a couple days ago, they said they saw a 65% chance of a U.S. recession in the next 12 months. Now they've just completely rescinded that call. Now I want to get to your question about the bond market. The bond market's often called, said it's deeper and smarter than even the stock market. So we saw yields really rise. A lot of people call that bond vigilantism. Bond investors responding, selling off bonds over economic concerns or concerns about debt. The president certainly paying attention to that, according to some of his cabinet members. Treasury Secretary Bessent said that. We also heard some of our reporters here at CNBC say that the president was watching the bond market. He thought investors in both the equity and the bond market were getting what he called yippee, kind of using a golf term when you can't just hit a putt. So those yields rising really puts a lot of pressure on the equity market. It just also is a sign of a loss of investor confidence. And this morning, there still is some questions about confidence in the equity markets. For example, a lot of questions about the impact of those sector-specific tariffs, especially on autos. This morning, we saw Goldman Sachs and UBS. They cut their price target on Tesla. UBS also downgraded General Motors. Goldman also downgraded Ford. And then we also continue to see concerns about big tech. Yesterday, we had a very notable investor, Altimeter Capital's Brad Gerstner, on our air. He said he spoke with a lot of big tech CEOs who say they feel reassured that they now have a bit of a framework when it comes to the president's tariff plan. However, we heard from a different voice today, Dan Ives from Wedbush, a very notable, fashionable tech analyst, also a big-time bull. He told a very different story. He believes spending on AI is going to pull back anywhere from 10 to 15%. Based on the uncertainty from tariffs. He also downgraded his view on the biggest tech stock in the market, Microsoft. He says tariff uncertainty and China tariffs are the main reason. And then we get to the big event today. That's the CPI report. Read on inflation. Estimates are for 2.6% year over year, a decline from 2.8% year over year. That could also have an impact on the bond market, just to go full circle. Back over to you.
CNBC's Frank Holland. Great summary of where we are at this hour this morning. Frank, thanks so much. So, guys, again, if you look at the futures, a lot of red on that board this morning. Yes, a bit of a recovery yesterday, not back to where it was a week ago, but a recovery for sure. Right. Not so much this morning.
Well, Treasury Secretary Scott Bessent said yesterday that President Trump's negotiating strategy was the plan all along. Take a look.
And we saw the successful negotiating strategy that President Trump implemented a week ago today. It has brought more than 75 countries forward to negotiate. It took great courage for him to stay the course until this moment. And that, you might even say that he goaded China into a bad position. They responded. They have shown themselves to the world to be the bad actors. And we are willing to cooperate with our allies and with our trading partners who did not retaliate. It wasn't a hard message. Don't retaliate. Things will turn out well.
Scott Bessent looks a lot more comfortable there than he did this weekend when he was talking about, a full-blown trade war against everybody.
For a long time.
There, again, if it's a single-front trade war, mostly focused on China, that's a bit easier of a message to sell economically and politically. Still tough economically, as we'll see today. But again, just politically, certainly on the Hill, much easier to sell.
So Fox business correspondent Charles Gasparino argued the abrupt tariff pause was not some sort of strategic calculation by Trump, but instead largely motivated by alarming sell-offs happening in the bond market.
I want to tell you right now that Donald Trump outsmarted the world. Trust me, I'm an American. I support my president. But that's not really what happened here, from what I understand. And what I understand, and I'm getting this from people that are talking to the White House, what happened in the bond market overnight, the spike in yields on the 30-year and the 10-year bond, which showed that people were dumping our bonds. And who were those people dumping our bonds? Japan, the biggest holder of bonds, was selling bonds. That's what I'm getting from some very big money managers. China, maybe to some extent, but it was largely Japan and others. If you have a mass sale of bonds, that means people are losing confidence in the U.S. economy, on the ability to do deals with us. And from what I understand, this is what forced the hand of this 90-day reprieve. Make no mistake about it, you cannot divorce this decision right here from what happened last night, which was, people focus on the stock market all the time. It's the bond market and the sort of lending markets that's the plumbing of the economy. And those markets were imploding last night. And that's why we have a 90-day freeze.
So, Zanny, let me read from the Wall Street Journal editorial page on that point. They write this morning that the bond rout was scary, with the 10-year yield hitting 4.47 at one point Wednesday, capping the steepest three-day yield climb since 2001. This was accompanied by a decline in the dollar against a basket of currencies. But can you explain for us again, why is it that when the bond market went sideways, that suddenly became a five-alarm fire?
Because I think that was a very powerful signal that markets, something very, very bad was happening in markets. Markets could seize up. The 10-year is like the bedrock of financial markets. It's the ultimate safe asset. And when the ultimate safe asset is behaving as it was yesterday morning, like a kind of scary emerging market bond, it's these enormous moves, things can break in the financial system, whether it's, a big financial institution, whether it's a hedge fund. Things can go very badly wrong. And I think, remember, you had me on your show earlier this week, and I said I was going to be watching the markets, because if they seized up, I thought the president might pause. And I think that's kind of what happened. And frankly, I'm delighted that that's happened. And I think it's what Secretary Bessent has probably been arguing for several days. And eventually sense prevailed upon the president, and it prevailed because of what he saw in the markets. It could have got very, very scary when, the most safe asset in the world behaves in that way. And I think we've forestalled a kind of chaotic market meltdown. But let's be clear, this is a moment of relief, but it is not over, and the damage has not gone away. A trade war with China, remember, the U.S.'s main trade, the second biggest economy in the world, is still a very big and damaging deal. And there are still big tariffs on other countries. They haven't all gone away. And the uncertainty about what will the outcome of all of these 70-odd negotiations be, I think will still mean that businesses stay on hold. So the damage of all of this is real and is going to be lasting. It's not as catastrophic as a financial market collapse would have been, but it's still real damage.